Hello guys, good day. Welcome to our first video lecture in ACC 325, Governance, Business Ethics, Risk Management, and Internal Control. I hope that you are all doing good. In this first video lecture, we will be focusing our attention with the concept of corporate governance. All right. So, based on our initial discussion of the subject, this subject will be divided into four major topics, namely that of the concept of governance, business ethics, risk management, and internal control. So, to start our discussion with the subject, we have here the first major topic of corporate governance. So, when we talk about corporate governance, it's actually from the combination of two words which are evidently corporation and governance. So when we talk about corporation, so again, this is a type of business organization that is owned by the shareholders and managed by the management. All right. On the other hand, when we talk also about governance, it is the leadership and direction given to a company so that it achieves the objectives of its existence. While management is about making business decisions, governance is about monitoring and controlling decisions. So, as what we have mentioned earlier, that it is the management who do the day-to-day activities of running the corporation. But again, in order to make sure that the resources invested by the shareholders are used in the right place, then governance will take place. It is to monitor and to control decisions of the management, again, to make sure that the resources are maximized. No? The resources of the shareholders are being maximized instead of possible misuse or possible misappropriation of these invested resources. Now, on the other hand, also, governance is considered as not into formulation of business strategy for the company. However, responsibility of the board and senior managers are for deciding strategy is considered as an aspect of governance. All right, corporate governance also is the conduct of business in accordance with shareholders' desire, which generally is to make as money as possible while conforming to the basic rules of the society embodied in law and local customs. So, one of the best feature of corporate governance is that it would be able to achieve the organizational objectives of the corporation, not discounting violation to different rules and regulations of different bodies of authorities. All right. Now, corporate governance has a really broad scope. It includes both social and institutional aspects. Corporate governance encourages a trustworthy, moral, as well as ethical environment. In other words, the heart of corporate governance is transparency, disclosure, accountability, and integrity. It is to be borne in mind that mere legislation does not ensure good governance. Good governance flows from ethical business practices even when there is no legislation. So, in order for um, an organization or in order for a corporate environment to live harmoniously, then therefore there should be a specific legislation that is not simply in words but a legislation that is being put into action by both the management and the shareholders or both to those people who have the control of the assets of the organization and the ones who are with the ownership of the organization. So as we have mentioned in our previous preliminary discussion about corporate governance, it is the shareholders who have the ownership and it is the management who have the control of the assets in the organization. All right. Another concept of good corporate governance is that it actually promotes investors' confidence, which is crucial to the ability of entities listed to compete for capital. Good corporate governance is essential to develop added value to the stakeholders as it ensures transparency, which ensures strong and balanced economic development. This also ensures, guys, that the interest of all shareholders are safeguarded, as what we have mentioned earlier. It ensures that all shareholders fully exercise their rights and the organization fully recognize their rights. So, in simple parlance, corporate governance really makes a healthy environment, gives a healthy corporate ecosystem with that of the management and the shareholders. All right. Now, let us proceed on the different definition of corporate governance by the different distinguished bodies. We have here the first definition from OECD. OECD is the Organization for Economic and Development. According to them, corporate governance is a set of relationships between a company's directors, its shareholders, and other stakeholders. This is also being considered as the structure through which the objectives of the company are set and the means of obtaining these objectives and monitoring performance. So as we all know, guys, that every organization, particularly in public corporations, publicly listed corporations, they do have their respective stated objectives. And these objectives would depend, or the achievement of these objectives would depend on how people in that corporation would work. And this corporate governance would actually be a great help for that corporation to achieve their objectives. No? If they do follow this corporate governance, code of corporate governance, then they could easily achieve their objectives. Because take note, guys, when we talk about corporate governance, it's also a set of provisions, right? Corporate governance is actually the same with a law or a regulation. It actually has a of um, list of provisions that is expected for a corporation to observe in running the corporation. Right? Now, the IIA or Institute of Internal Auditor also defines governance as the system by which a company is controlled and directed. Governance includes the rules and procedures for making decisions on corporate affairs to ensure success while maintaining the right balance with stakeholders' interest. Governance is the leadership and direction given to a company so that it can achieve the objective of its existence. It doesn't actually help achieve objectives, but it achieve it helps to achieve the objectives na without stepping any rules and regulations. All right? There are corporations na they are too focused on achieving their objectives up to some point na they don't mind that they have already violated some rules or some laws of the land. For example, if not all, no, those for example are related to wasting assets, for example extraction of minerals, if they are too focused on extracting the most number of minerals without considering the possible effect with that in the environment, or extracting minerals without considering the possible effect with their waste disposal, could be very harmful to the environment. So governance, through good corporate governance, the corporation would be able to achieve its objectives na harmonious. Meaning, it it brings other stakeholders together with the corporation go up, no? Not the other way around. All right? Now, the other definition is that from Cadbury report of 1992, which considers corporate governance as the system by which organizations are directed and controlled. No, just the same with the previous words. Corporate governance is really a guide, considered as a guide on how to run a particular corporation. Now, we need also to consider the definition of corporate governance in the words of the Philippine Securities and Exchange Commission. According to the Commission, corporate governance is the system of stewardship, right, and control to guide corporations in fulfilling their long-term economic, moral, legal, and social obligations towards their stakeholders, including but not limited to customers, employees, suppliers, shareholders, investors, creditors, the community, the company operates in society, the government, regulators, competitors, and other external auditors. It is also being considered as a system of direction, feedback, and control using regulations, performance standards, and ethical guidelines to hold the board and senior management accountable for ensuring ethical behavior, reconciling long-term customer satisfaction with shareholder value to the benefit of all stakeholders and society. So again, corporate governance is really considered as driver, no? It's manual. It's considered as manual to the driver para ang ang destination sa corporation would really be, really be good in the point of view of all stakeholders concerned in that corporation, may it be internal or external na stakeholders. Okay? So, based from those concept of cor- um, corporate governance, let us proceed this time with the benefits of having good corporate governance process. So what if we have good corporate governance? What does it bring to the corporation if a corporation practices and observes good corporate governance process? So number one or letter A, the company will have improved risk management system. So if the company is observing the code of corporate governance, then it could have a very good and competent risk management system. When we talk about risk management system, it's actually the identification, evaluation, and prioritization of risks, followed by coordinated and economical application of resources to minimize the impact of unfortunate events. So, as we have identified, risk management is mitigating the possible result of the presence of risk. So, if we have good corporate governance, then we would not be able to suffer for the worst case scenario that a risk could bring to the corporation. As we all know, risk is inevitable. Risk is always present. So, in order for us to help lessen the effect of that risk or lessen the impact of that risk, then good corporate governance would help us with that. All right. Letter B, there will be a clear accountability for executive decision making. So, accountability meaning the act of being responsible. All right. So, it is the executive who does decision. All right. So, although guys, take note that these executive people in the corporation are actually not the owners. No, there are executive who are owners because there are executives that are the same time shareholders. There are also times that there are executives that are also directors. But technically speaking, when we talk about executive people in the organization, they are they are the management and they don't actually own. Technically, they don't own shares, for example. So that means they could possibly do whatever they want. So therefore, in order to make sure that are secured, the shareholders are safe from possible misuse and misappropriation of their resources invested in the organization, then therefore these people who are responsible in making decisions will be accountable. meaning whatever is the result of their actions, they are held accountable to that. Okay? And letter C, it focuses management attention in introducing appropriate systems of internal control. So obviously, internal control is very important because it will help us achieve our objectives. Okay? It also encourages ethical behavior and corporate social responsibility. It can help safeguard the organization from the misuse of assets and possible fraud. And it can help to attract new investment into a company. Because take note, guys, when a company or a corporation is considered as a corporation that has a strong corporate governance. That is actually a very big plus in the eyes of the investors because that could build a corporation a strong goodwill that the investors are willing to pay premium just to become an investor of that corporation that has a good image of good corporate governance. And lastly, letter G, it seeks to put limitation on excessive director remuneration. Actually, guys, one of the code of corporate governance issues the possible limitation of director remuneration. No? Just to make sure that directors wouldn't be able to take advantage of the powers they have. And again, it is also a measure to protect the resources invested by the organization. All right. Now, this time, let's proceed with the pitfall or the downside of the governance. No? Downsides of a governance. Letter A, it could develop an excessively risk averse culture amongst managers. All right. When we talk about risk averse, guys, risk averse is we avoid the risk, no? Instead of possibly earning more and engaging into risky transactions or risky investments, because as we all know, the law on investment, the higher the return or the higher the risk, the higher the return. So if it's actually with governance according to the text, it could develop an excessively risk averse culture. All right. The third B, there could be too much reporting and not enough time to seek and pursue profit making activities. So, as we all know, corporate governance assures that the corporation is not violating any rules and regulations or any provisions of any government regulatory agencies. So, therefore, the corporation would really need to supply reportorial documents to different agencies. For example, Securities and Exchange Commission, BIR, Bangko Sentral ng Pilipinas, if it's applicable, and the likes. Okay? That could, again, kung too much reporting, too much effort and time is being given to that aspect, then there could possibly be a limitation on possible earning of profit. Letter C, it could damper entrepreneurial activities. Letter D, there could be too much excessive supervision, red tape, and bureaucracy. Bureaucracy, guys, it means that an organization that is complex with multi-layered systems and processes. This is designed to maintain control in an organization. So as what I have really mentioned earlier nga, that the concept of corporate governance is really it's really to make sure that the corporation is transparent, no? So that is why everything that is material is required to be disclosed in order for all the stakeholders, not just the shareholder and the management, would be able to know what they have, what they are required to know. Okay. And letter E, the cost of operating internal controls could possibly exceed any benefit. So the law on um, cost and benefit. So much of internal controls, strong internal controls could possibly lead into earnings of lesser benefit. Pero take note, guys, that is the idea na always we consider incurring something as long as the benefit will the benefit will exceed the cost that we have incurred. Okay? So you just have to consider that. Pero there is a possibility talaga na corporate governance cost, the cost of having strong corporate governance might actually exceed any possible benefit from that. And letter F, there is possibility that the focus on meeting different stakeholder expectation will confuse management as to their corporate responsibilities. Okay? All right. Now let's proceed with the purpose of governance. Okay. The purpose of governance is actually to facilitate the effective entrepreneurial and prudent management that can deliver the long-term success of the company. Good corporate governance should contribute to better company performance by helping a board discharge its duties in the best interest of the shareholders. If it's actually ignored, the consequences may well be vulnerability or poor performance. Good governance should facilitate efficient, effective, and entrepreneurial management that can deliver shareholders value over the longer term. In the words of the Securities and Exchange Commission, it has highlighted that corporate governance is to help, no, the purpose of it is to help build an environment of trust, transparency, and accountability necessary for for fostering only for fostering long-term investment, financial stability, and business integrity, thereby supporting stronger growth and inclusive societies. All right. Corporate governance, it actually makes a corporation friendly to all stakeholders. Okay? Corporation is equal to transparency and accountability. All right? Now, this time let's try to discuss governance and other important concepts, underpinning concepts. All right? We have there number one, honesty and probity. Honesty and probity, it means being honest. Be honest that statements about the company are truthful, not putting a spin on the facts. So if you are, you know, practicing good corporate governance, you don't actually um, necessarily beautify your reports. No, you need to be very objective. That means the reports should have the quality of having strong moral principles, and the corporation should behave correctly. All right. Letter B, we have their accountability. Accountability, the emphasis is the manager's accountability to the shareholders, but also accountable to other possible stakeholders. Meaning, managers, the executive, or the management in particular or in general are not just accountable to the shareholders, but are also responsible to their actions with that of other stakeholders. Take note, guys, shareholders are different from stakeholders. Shareholders, they are the ones who own shares in a corporation, while stakeholders are those um, they are persons, individual or entity that is being affected by that particular corporation. All right. We also have letter C in the point of view of independence. The emphasis is making sure that there are truly non-executive directors on the board who are free to critique the job performance of management, and independence is not actually having a conflict of interest issue. So in the board of directors, guys, sa code of corporate governance, it actually provide a provision that there should be a um aside from diverse na combination of board of directors, there should also be um there should also be a level of independence that is being considered by the directors. And how could directors become independent? Therefore, there should be someone in the board of directors that is non-executive, because we have two types of directors, guys. We have the executive directors and non-executive directors. Executive directors are those involved in routine management of the firm, or in short, they are full-time employee of the firm. No? They are part of the management team, and at the same time they are part of the board of directors. So obviously, we could not really expect 100% independence from this type of um, independence. We could not really expect 100% independence from this type of director. So that is why there should be someone, and that someone are your non-executive directors. And your non-executive directors are the members of the board that do not have actually management responsibility. So therefore, they could create decisions for the board that is not influenced in one way or another by the management. All right. Now, letter D, we have responsibility. Responsibility, the board has a responsibility to oversee the work on management. The board should also retain responsibility for certain key divisions or certain key decisions, such as setting strategic objectives and approving critical capital investments. So it's the responsibility of the management to do decisions for the management, and it is also responsibility of the board. Okay, it's the responsibility of the board to oversee the management of what they are doing. All right. Another is decision making or judgment. So when we talk about decision making or judgment, all directors are expected to have sound judgment, to be objective in making their judgments. The OECD, or as what I have mentioned earlier, the Organization for Economic and Development says that the board should be able to exercise judgment on corporate affairs independent, in particular from management. So, yun yung sinabi ko kanina na with level of independence in their decision making that they are doing, they should create decisions for the corporate affairs that is free of influence in one way or another from the management. Okay, because guys, if the directors would, you know, would be influenced by the management, then the directorship would be of no use at all. Ano man? Why? If they are being influenced by the management, then let the management be the, be the director. No? What's the point of having director if the directors are being influenced by the management? So therefore, in order to have a fair and fresh ideas, then therefore they should create decision making or judgment for corporate affairs independently. And then in terms of reputation, a company's reputation, if good, is built on success and management competence. However, it might take years for a company to gain its reputation and only a day for it to get ruined. So companies that are badly governed can be at risk of losing goodwill from investors, employees, and customers. So as what I have told you earlier, guys, that if you have a good corporate governance, that means you also have a strong goodwill. And if you have strong goodwill, then you have good reputation. And take note, one of the factors that affects investment decisions of different individual investors and institutional investors is the reputation of the corporation. So if you don't have this good reputation, then therefore possibly you will run out of possible investors and could possibly um, give you problems in terms of financing later on. And we have integrity. This is similar to honesty, but it also means behaving in accordance with high standards of behavior and a strict moral or ethical code of conduct. This means doing the right thing and being a straight shooter. All right? You should try to accomplish your job in the right thing possible. Okay? And then letter H, we have fairness. This means that all shareholders should receive fair treatment from directors. One share is equal to one vote. This also means taking into account the other stakeholders of the company, such as suppliers, creditors, employees, or local community, among others. And lastly, guys, you have the transparency or openness. This means that this means not hiding anything. Transparency means clarity. This involves full disclosure of material matters which could influence the decisions of the stakeholders. So transparency, guys, the level of transparency could be somehow be related to their financial statements, right? They should. That is why publicly listed corporations are required to publish their financial statements. All right. Now, if you don't know, guys, this code of corporate governance is only applicable to publicly listed corporations. No, according to the Securities and Exchange Commission in the Philippines, it's actually the publicly listed corporations or the corporations who are issuing shares to the public are required to follow code of corporate governance. And in that code of corporate governance, they are actually um, requiring publicly listed corporations to publish or to issue their complete set audited na financial statements. Okay, so that is transparency. All right. Now this time let's proceed with the organizational life that is being affected by corporate governance. Okay? You have there letter A, duties of directors and functions of the board, including performance measurement. Directors have a fiduciary duty to act in the interest or the best interest of the company. They need to use their powers to proper purpose, avoid conflicts of interest, and exercise a duty of care. So when we talk about fiduciary duty, it's a legal obligation of the highest degree for one party to act in best interest of another. So take note, guys, these directors are elected by the shareholders. So therefore, directors should be able to do their best in making decisions that could benefit the entirety of the shareholders. Okay, there should be no um, individual interest, or in short, there should be no conflict of interest in terms of the directorship. Another is the composition and the balance of the board. As what I have told you earlier, guys, the Code of Corporate Governance requires the board composition to be diverse. Therefore, it should be balanced, balanced in terms of skill and talents from several specialisms relevant to the organization's situation, and also in terms of age, to ensure senior directors are bringing on newer ones to help succession planning. So when we talk about board diversity, it means a move to avoid groupthink and ensure that optimal decision making is achieved. No? Groupthink, guys, is a mode of thinking in which individual members of small groups tend to accept a conclusion whether or not they believe it to be valid, correct, or optimal. So that is why the board is required to be diverse. Meaning, it should not be focused on one profession. For example, it should not only be focused on CPAs, on business people, on people who are working in the academe, in education. There should be diverse individual who could competently give good ideas to the organization. All right? And take note, it should also be balanced in terms of age to ensure senior directors are bringing new breeds in the corporation. It is actually a help also to prepare succession planning. So what do we mean by succession planning? As we all know, guys, that all these will have their retirement. So therefore, the corporation will not be paralyzed if that retirement of these senior directors would come because there are already new breeds who are equipped enough, who are trained enough to continue their work, continue their legacy in bringing in achieving the objectives in the organization. All right. Now, I have read something, guys. I think it's I have read it in some of the position papers of the Securities and Exchange Commission of India, where they have mentioned that a strong and healthy composition of the board is that healthy daw ang composition sa board when the board are willing to retire if or willing to resign or willing to step down on their position if they think that they could no longer contribute enough in the achievement of the objectives of the organization, no? Where I think that is very good kasi if you are no longer of use in an organization, 'di ba? You should step down, no? You should not have greed to power. You should not have greed on money, no? You should look at the broad benefit that you could bring to the organization. So, just like in a relationship, people, you know, if you think that you don't contribute anything for the development of some individual, then goodbye. That's actually a respect for yourself, all right? Now, let's proceed with letter C. All right. Letter C is reliability of financial reporting and external auditing. Now, where CPAs, you guys in the future would be um, the responsible. The reliability of financial reports is critical to ensuring that management is held accountable. External auditors need to make sure that they are getting the right information in order to verify reliability of financial reports. External auditors cannot be fearful of asking awkward questions because of fear of losing the audit. Take note, guys. Let me remind you first of the purpose of an external audit. No, external audit is making sure that the interest of the public is protected. So therefore, as an external auditor, we should be able to make sure that the financial statements are prepared in accordance with the standard, and we should not be able to we should not be failed on that aspect. If we need to be fearful, then we should be fearful in asking, questions that could make sure that these financial statements are really in accordance with PFRS or are really in accordance with the specific current standards that is mandated to be followed. All right. So again, the concept of mindset, skeptic mindset, you need to consider that the information given to you is honest nor dishonest, just to make sure, guys, that um, the financial statements that is presented by these corporations are reliable. Because take note again, the are different stakeholders, internal and external, particularly ang external na mga stakeholders nato are relying to whatever financial statements that is published or issued by this corporation. So therefore, if we failed to scrutinize, to ascertain that the financial statements are in accordance with a particular standard or prepared fairly, then we also failed to protect the interest of our public. All right. Now, let us proceed with letter D, director's remuneration and rewards. Director's remuneration has to be seen as being fair. Excessive salaries and bonuses have been seen as one of the major corporate abuses for a number of years. All right. This corporate of governance also affects, no? As what I have told you earlier, na um, there is a mechanism that is brought by Code of Corporate Governance to limit the remuneration and rewards for these directors. So kung wala ay practice of Code of Corporate Governance, then there is a possibility that the director's power to provide remuneration and rewards for themselves might be abused. Okay? And letter E, responsibility for the board for risk management systems and internal controls. Boards should meet regularly as to provide proper oversight for risk management and internal control systems. Without proper oversight, the organization may have inadequate systems in place for measuring and reporting on risk. Now, take note, guys, that this board of directors would meet regularly, monthly. No, they meet monthly, pero in some cases they could also call for an emergency meeting. Okay, just to make sure that there is proper oversight to the day-to-day activities in the organization, and to make sure that controls are properly implemented, adequate controls are properly implemented. And then letter F, the rights and responsibilities of shareholders, including institutional investors. Shareholders should have the right to receive all material information that may affect the value of their investment and to vote on measuring affecting or to vote on measures affecting the organization's governance. And lastly, guys, corporate social responsibility and business ethics. So, corporate social responsibility and business ethics is an important part of the corporate governance debate. At this point, there is not really a consensus about these issues. So, as what I have told you earlier, guys, that with Code of Corporate Governance, it brings not just the corporation itself to success, but even it brings the community and other stakeholders to success also through corporate social responsibility. All right? Sige. Now, this time, let's proceed with roles, interests, and claims of internal parties involved in corporate governance. Okay, the first internal party is your directors, guys. So, directors, do not worry because we will have a separate discussion on what are the responsibilities of these directors. So in the third chapter for corporate governance topic, we'll discuss all the roles and responsibilities of the director. But for introduction, preliminary thoughts about directors, they have an operational role in running the company, developing strategies, among others, concerning corporate governance. And directors have actually the role to act responsibility, to act with honesty, and be accountable to their job. Okay. So, actually, si director, sila ang nag-oversee, no? Directors, as what I have said, these are also shareholders. They are elected by the shareholders to become board, and this board of directors will be supervising or overseeing the management. It's them who creates strategies, long-term, short-term strategies, and objectives for the organization. No? Pero it's the management who will implement this. As to how the management implement these objectives, then that will be the job of the directors to follow up, to oversee, and to supervise. Okay? Another is company secretaries. Company secretaries are an officer of the company, and as such, they have an operational role in the company. For example, company secretaries might sign some contracts or declare some relevant matters to proper authorities. They also have the role to play in corporate governance by making sure that the directors are complying with corporate governance. Some of the functions of or responsibilities of the company secretaries are actually listed in your um, module. So please refer it to your module na lang. Alright? Now, letter C, we have their sub-board management. Okay? So when we talk about sub-board management, if a manager is not on the board, then he or she is considered to be part of the sub-board management. This person might be the purchasing agent, human resource manager, and among others. It concerns operational roles. Directors develop strategies to achieve some objective, and it will be the sub-board managers who have to take the strategy and develop the tactics to achieve the objectives of the organization. So take note, see sub-board management, this is apart from managers who's not member, apart from the managers who is not in the board. So therefore, these are the the front runners of the management, no? Sila ang ang naay actual na interaction sa mga stakeholders ni corporation, may it be sa mga empleyado or sa mga suppliers, internal and external stakeholders. And also, sa board management like your supervisors or your division managers, they are the ones who create specific objectives, no? Specific na mga strategies. So, the context with that is that the board give, will craft general objectives or general strategies. Pero each of these managers, guys, in the management side, will try to convert that into a more specific strategy, a more specific na objective that their department could contribute for that organizational objective to be achieved. All right. So, for example, in the accounting department, so they will convert that they would convert that general corporate objective into the parlance of the accounting department. Okay? How would they be able to contribute to the achievement of that general corporate organizational objective or goal? All right? So that is the job of the sub-board management. Okay? And then also we have there your employees, the heart of a corporation. Employees have an operational role to carry out the tactical plans of the sub-board management. So as far as corporate governance, the employees have the responsibility to comply with the corporate governance systems in place and adopt appropriate culture. They need it to implement the risk management and control procedures and to report back if controls are not working as they should. So employees talaga, these are the workers, the frontliners to make the objectives of the organization realize. No? Employees makes the reality of the specific objectives of the division or the department. And this department, with the combination of all the departments in the corporation, will make the reality of the achievement of the entire objective of the corporation. So that is the ladder of the reality of goals in a corporate setting. And then you have your unions. Lastly, unions have the responsibility to protect the interests of the employees. As such, the ability of management to alter its working practices, for example, may depend on obtaining the cooperation and support of trade unions. Trade unions, this is a group or a body of employees that is somehow um, present to make sure that employees are not deprived of the rights they deserve. Okay? And it would actually voice out, no? In possible working practices that the management could bring to our employees. All right, so those are the internal na mga stakeholders in the organization. So this time, lastly, for this video lecture, let's proceed dito kay external parties involved in corporate governance. The roles, interests, and claims of external parties involved in corporate governance. So we have there number one, your shareholders. The rule of governance is protect the rights of all shareholders, including the right to vote for board members. So again, as what I have said earlier, again and again, Code of Corporate Governance is there to make sure that the welfare of the shareholders are secured. The board of directors are not the board of directors, but the corporate governance also gives the power of the shareholder the right to vote for board members. So it's the shareholders who will vote for the board members and then or board of directors, and then si board of directors naman ang mag-elect for the board officers like the chairman of the board, the corporate secretary or corporate treasurer. Another guys, your external auditors. So again, tayo ito, CPAs working in the public industry. Auditors are there. Auditors try to influence to the company to present reliable and accurate financial statements. So we will not give them the opinion they want. For example, the unqualified opinion if their financial statements doesn't say so. All right. So auditors can influence by recommending ways to improve the strength of internal controls within the company. So if there are necessary adjustments, so we proceed to laying down the adjustments required for their financial statements in order for them to be given um, the best opinion that they want. They can also provide other audit services such as social and environmental audits. They could also highlight governance and reporting issues of concern to investors. So that is why you people, you guys as future external auditors really would play a big role in the future. You would have a vital role in protecting the public's interest. All right. So if you become a certified public accountant and if you become an external auditor, you should be proud of what you're doing and your job because you protect the people. No? We are public defenders in our own way. All right. We we defend the interest. We protect the interest of the public. And then we have there your regulators, guys, like the Securities and Exchange Commission, among others. Like as what I've said earlier, we have Bangko Sentral ng Pilipinas, BIR, and the likes, have a role of making sure that public companies' financial information is transparent, reliable, and accurate. So that is why every year, the Securities and Exchange Commission is required to issue financial statements, audited financial statements. Now, they will be penalized, and that could be a possible ground for the revocation of their franchise to operate as a corporation if they would continuously disregard that um, provision from the commission. No, so it develops a scenery of transparency, reliability, and accuracy of information for the public. Regulation can be defined as any form of interference with the operation of the free market. This could involve regulating supply, price, profit quantity, entry, exit, information technology, or any other aspect of production and consumption in the market. Although, um, there are regulators that are so meticulous, guys, that could somehow um, irritate the workers in the point of view of the corporation, but we have nothing to do about that. That is important. That is a safeguard, right? That is safeguard, no? That's control of the government placed to protect the public. And then we have their letter D, government, like regulators. The government has a role to make sure that regulators are doing their job and making sure that public companies are abiding by the laws and regulations of the country. Government is the one who oversees the regulators. The regulators, like the Securities and Exchange Commission, will be the one to regulate all the publicly listed corporations. Okay. And then, stock exchanges. Public companies list their shares on regulated stock exchanges such as New York Stock Exchange, American Stock Exchange, and so on and so forth. In a local setting, our counterpart is our Philippine Stock Exchange. No? Stock exchanges are privately owned and thus they need to protect their reputation. Stock exchanges are regulated and thus require listed companies to abide by governmental regulations. Stock exchanges are important because they provide regulatory framework and principle-based jurisdictions. Stock exchange regulation can therefore have a significant impact on where corporate governance is implemented in companies' report. Also, we have last our investors, both small investors and your institutional investors. Small investors, the role of governance is to protect the interest of minority shareholders, to make sure that their voices are heard and that they are treated equally. Actually, guys, the Code of Corporate Governance also has provided that in the board, there should be a representation of the minority shareholders. All right? Because take note, guys, if no provision like that ang gi-implement ni Code of or need corporate governance, then obviously ang ato ang minority shareholders will really have the chance, will really not have that chance to be represented in the board of directors. Nga naman, take note that one share is equivalent to one vote. So therefore, you can't really, for example, if you only have 100 shares, 1,000 shares, you can't really vote yourself to become a director, no? So that is why the the board of director has provided a provision that every composition of board of director in a publicly listed corporation, if I'm not mistaken, you can read it in the Code of Corporate Governance, which I am be sending to you also, that at least 10% of the minority shareholders will be represented in the board. No, that's how the Code of Corporate Governance is being, um, being protected and given equal treatment. And then lastly, guys, letter G, institutional investors. Institutional investors, these are, they analyze and discuss the role and influence of investors, institutional investors in corporate governance systems and structures. For example, the roles and influence of pension funds, insurance companies, and mutual funds. Institutional investors manage funds of individual investors. They are organizations which pool large sum of monies and invest those sums in security, real property, and other investment assets. They can also include operating companies which decide to invest in its profits to some degree in these types of assets. So institutional investors, guys, these are corporate investors also, no? Investors that are artificial being, or investors that are organizations, no? So those are institutional investors, and institutional investors also are just like our minority shareholders. Small investors are also protected by the Code of Corporate Governance. All right, so those are the important points that we need to remember, to consider, and to observe in the whole context of corporate governance. So in short, just a very um GS the very heart of this video lecture is that corporate governance really brings a healthy ecosystem in a corporate environment. Okay? So I guess that would be the end of our video lecture. So if you have more queries and clarifications, do not hesitate to write it down and voice it out during our town hall meeting on the coming session, or you can comment down below for possible clarifications. So thank you very much for watching, and God bless everyone. Thank you.